Good morning to you both. We have major averages lower right now. Barry, I'll start with you. I mean, there are a lot of cross currents here. We've been talking about them every day, whether it's the Fed, whether it is earnings, whether it is inflation, and of course now geopolitical risks with this Russia invasion of Ukraine. How do you cut through it, parse through it, and basically figure out where to put your money to work as an investor right now?
At the broader market level, starting out in the year, we thought the S&P would drop from 4,800 to 4,200, and it did. Just yesterday, I said that it would go to 4,050, down another 7%, and I think it'll hit that before the end of the month. Risk is rising across the board. Emerging market credit default swaps, a measure of credit risk in emerging markets, are soaring. High-yield option-adjusted spreads are going up. Investment-grade spreads are going up. What's called the LIBOR OIS, a measure of the scramble for dollars, is going the wrong way. And oil prices are really going to squeeze the consumer. And now we have food prices as well, with disruptions from the Baltic to Brazil. I think it's just terrible what's going on, and monetary anesthesia really can't cover it up.
A lot there to unpack. But first, Sherry, the bond market, what is that telling us right now? And we have the 10-year yield continuing to move lower. It fell below the level that it opened at last Thursday as this invasion was really ramping up in full force. And it's gone from there. So you could argue that there's this divergence taking place between the bond market and the equity market right now. I mean, I realize we're in the red for equities, but we've seen a bit of a rally over the last couple of days nonetheless. Which market should investors pay closer attention to right now, and what are the signals telling us?
Yeah, thank you for having me. I think what the market's telling us right now, in the midst of these historically unprecedented times, is that basically investors should be deploying a standard investing playbook. And what that looks like right now is adjusting asset allocations in both your bond and your stock portfolio to address inflation, and understand that that will inherently bring more volatility to a portfolio, because in many instances we could see the stock and the bond market go down as each of those asset classes re-rate this current environment. And basically that playbook, as with regards to the stock market, means really tucking up into cash flows and balance sheets that can withstand this dynamic and quickly changing environment. Share buybacks and dividend increases will win the day. We have got a reopening trade that, for all intents and purposes, we could really step into the back half of that this year. So there's a role for small and mid-cap stocks here in the U.S. and client portfolios. And then to insert what we're calling an inflation airbag within portfolios to really look at REITs, private equity, commodities, and then to unpack the S&P and stop viewing it as one entity, but different bull and bear markets within 11 sectors of the market. So that would put you in financials. Today, actually, would be, an interesting day to step in because the financial sector is sort of also debating the rate hike climate. And so our advice to clients is to really go down the middle of the road on this market right now, while we all sit and watch and participate in, this devastating trauma from a privileged perch sitting here in the United States and in the greatest capitalist democracy.